Good morning. Welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me at MarketSite is Jonathan Molchan. He's Director, Portfolio Manager, and Head of Product Development over at Horizon ETFs. And of course, Irv Resenzweig. He's President and Head of Investment Strategies over at RZ Wealth. And we're going to focus on beyond passive investing. Jonathan and Irv, thank you both for joining us at MarketSite this morning. And I'm going to kick it off with you, Jonathan. So Horizon offers a number of covered call strategy ETFs, which we have covered before, both the inside ETFs and at MarketSite. So tell us more about the objectives and characteristics of your more popular portfolios.
Sure. So the key objective is enhancing yield and reducing volatility. I think the desired characteristics of our covered call strategies are that they give you the underlying equity exposure that most people already have, but they couple that with monthly options premium, as well as stock dividends in the form of a monthly dividend payout with lower volatility than a traditional long-only investment.
All right, and we've seen covered call strategies to some degree, notably in the closed-end fund arena. What makes the covered call strategies at Horizon ETFs unique or notable?
Sure, so I think the key difference between a covered call strategy and an ETF versus a closed-end fund is that closed-end funds have a tendency to not trade in line with NAV, and some can employ leverage. We do not employ leverage, as well as with the ETF in a very cost-efficient wrapper, you're getting professional options management, and you're benefiting from economies of scale that will pass on the cost-efficient nature to the end investor.
All right, Irv, let's switch it over to you. You're the Advisory Leadership Council with the Options Industry Council. We've done a lot of work together. What makes these particular ETFs attractive for managing your clients' portfolios?
Well, with Horizons, following the main indices, what you have is essentially the ability to incorporate a core into what we do. So the strategies that we can do would then function as satellites around that core. What we do can be time consuming, and certainly some of the software and programs that we've incorporated have helped a lot. Mark Chaikin's actually here today, so Chaikin Analytics we use in that regard, and that's been a big time saver. In addition to that, the expense of it, and just knowing that through Horizons, you've got professional expertise, you've got relatively low costs associated with doing it, and again, just being able to incorporate the income and having that paid out on a monthly basis is a great benefit.
And outside of what you just mentioned, are there other reasons to consider option strategies for RIAs within the portfolios that they manage?
Yeah, I think it's a differentiator. Aside from attracting business and things like that, there's not a lot of people that venture into the area of options. So because of that, number one, you're going to want to seek out professional management. That's why Horizons does a great job with that. But again, I think it pays to educate yourself as well. There's a lot of advanced strategies that, frankly, I don't think you need most of them. But the basic stuff, as far as a covered call strategy or a cash covered put, or even to minimize risk with a put, I think that's all credible and stuff that really needs to be incorporated. If you're going to try to control certain aspects, you can't control the market and you can't control whatever tax laws are going to be and things like that, but you can incorporate some systems in there that will mitigate or manage risk. You can also try to tax harvest, so you can tax manage to a degree, but aside from that, if you don't incorporate these tools, you're just going to be pounded around by whatever the indices are going to be doing.
All right, well, Jonathan, let's go back and talk about the strategies that Horizons ETF has. And there's three of them: QILD, HSPX, and USDY. What are the differences with the three?
Sure. So the two covered call strategies are QILD and HSPX. Those both track indexes that were created by the Chicago Board Options Exchange. QILD is a monthly at-the-money covered call on the Nasdaq 100. We own in full replication the stock components of the Nasdaq 100, and then use index options at a predetermined strike each month, so it's a very transparent process. HSPX is similar, except that is 2% out of the money, and that owns the underlying of the S&P 500. Very similar process. USDY is new, came out in February of this year. That is a factor-based strategy that tracks the Russell 1000. We then have a proprietary options overlay that's designed to be a hedge to minimize drawdown in the event of a market sell-off. The key characteristic of this overlay is that it's costless. So we are selling a call to purchase a put to provide protection for the overall portfolio without carrying a cost of that protection.
So it sounds like the objectives are to generate income and minimize volatility throughout the 3 different ETFs.
Yes, so though the strategies may differ, the key objective is income or yield and reducing vol.
All right, and Irv, we're going to wrap this up with you. What's your main objective when trading options for clients, and how do strategies like the Horizons ETFs fit into this?
Well, again, the income is the number one thing, for sure, where we can not be sensitive to the fixed income, to risk associated with fixed income. So we don't have credit risk, we don't have duration risk, we don't have the interest rate risk, we can have market risk associated with having this strategy, but again, you've got a different set of risks than what fixed income would provide. Seeking yield in fixed income, you're going to go further out there relative to maturity and yield, which is going to then incorporate more risk. You don't really have to do that. You've got a couple of components working here. The fact that Horizons uses the actual, holdings within the portfolio, you potentially have a qualified dividend coming off those holdings. You then have the premium coming off the sale of the options, and then in addition to that, the fact that they actually use index options in the portfolio, those are Section 1256 contracts, which get a little complicated, but there's some potential for tax benefits there because a true 1256 contract is taxed 60% long-term gain, 40% short-term gain. So there's different components working here. It's subtle. And again, they just add another dynamic to our practice, which I think is a differentiator and actually at the end of the day is beneficial to the client. The ability for us to do due diligence, the fact that there's professional management, the fact that there's low cost, these all tie into what an RIA needs to do to best look out for the well-being of their client.
Sounds like you have the fiduciary basis covered with this.
Exactly.
All right, well, thank you both for joining us at MarketSite, and thank you for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.